Are you someone who likes a good sale, likes a good discount? Well, in my opinion, and we can agree to disagree, but there is no better discount than a discount on taxes. Now, in this video today, we're going to be talking about a very powerful tax strategy that retirees can use right now, Roth Conversions. We're going to be talking about how you can gain a discount on your Roth conversion, get more out of your Roth conversion from year to year. And so we're going to be talking about how you can use market volatility on an ongoing basis in order to gain a Roth conversion discount. Now, come along with me as we talk through how you can use this effectively inside of your retirement. Now, very important disclaimer right off the front end. I'm recording this in January of 2022. It happens that financial markets are in a downturn right now. This video is not specific advice for your situation. The majority of you watching this video, I don't know anything about your situation. So please use experience help in performing any kind of tax strategy, any kind of move within your retirement. Okay, now that we have the disclaimer out of the way, let's get into it. And so what exactly do we mean to perform a Roth conversion at a discount? Well, essentially what we mean is your portfolio is in a given drawdown. Now, this happens to be if we believe the market is going to recover, your investments are going to recover. This happens to be a very opportune time to perform a given Roth conversion. Let's jump through an example here. So let's say at the start of the year, our traditional IRA is worth $1.3 million. Okay, at some point in the year, we happen to be in a drawdown. There's some market volatility that we're experiencing. And our portfolio has dropped by 15%. We're at a 15% loss. And so our entire traditional IRA has now transformed to 1.1 million. Well, if we believe the market is going to recover, this happens to be a fantastic time to perform a conversion because we're going to perform a conversion that we otherwise would have performed anyway in the given year. Let's say a $100,000 conversion. And now what's going to happen as the recovery happens on whatever given timeline that recovery happens on, that conversion, that recovery is going to happen inside of our Roth IRA rather than happening inside of our traditional IRA. We're at a 15% drawdown. Our $1.3 million traditional IRA has turned to 1.1. And so we're going to perform, let's just say hypothetically, a $100,000 conversion. And just for simplicity reasons, we're leaving out taxes here. We're performing this $100,000 conversion. And now what's going to happen is we're going to end up with $1 million inside of our traditional IRA and $1 million inside of our Roth IRA. Well, over the whatever given timeline it takes for the market to recover, the market recovers back to break even. Now you'll notice that we were at a 15% drawdown and the recovery needs 17.6% of a gain to get back to break even. That's because losses hurt more than gains help. If we lose 50% of our wealth, we need to make 100% to get back to break even. And so you'll always notice after a drawdown, it takes a higher percentage return to get back to break even. And so to get back to break even, we need to see a 17.6% gain within our investments. And essentially what's going to happen here is both our traditional IRA as well as our Roth recover. But what's happening here is that recovery is happening inside of the conversion rather than happening inside of the traditional IRA. And so in a sense, we were able to convert $117,647 after this recovery at a tax rate of whatever we paid on that $100,000 conversion. Thus, we got more out of that conversion, or said otherwise, we got a discount on that conversion. And so this is a pretty powerful concept that we talk a lot in our practice. What I see a lot of times is people only making changes or making decisions when we're in fairly good times, when the market continues to reach higher highs. And it's important to understand during every market cycle, there is an opportunity that's presented, but each of these market cycles represents a different opportunity. For instance, when we're in a drawdown, there's a lot of tax implications, a lot of tax benefits that we can gain from making changes during a given drawdown. Again, we have to assume a couple of different things. We have to believe that the market is going to bounce back, and hopefully we do, otherwise we probably shouldn't be investing at that point. We have to have a long-term view. Again, we don't know how long it's going to take for the market to recover. We have to understand that we can't time things perfectly. We might be converting at, let's say, a 15% discount, and the market might drop to 20%. Okay, we should have waited theoretically to convert, but we can't time things. And so we have to pick our battles, pick our spots. And we have to also make sure that our plan obviously supports any given strategy. But the important thing here is during every market cycle, during every market phase, there is an opportunity for you to step your retirement forward. Again, in market downturns, there are typically tax opportunities like tax loss harvesting, like performing a Roth conversion at a discount. And so typically every year, depending on what given assets we're investing in, let's use the stock market, for example, the S&P 500, in every year there's often an opportunity to perform one of these given conversions at a discount because there is, well, market volatility from year to year. We may end the year up, let's say 20% in the market, but during that year, there may have been times where we were actually down 5-10%. Most of the time, we've seen the stock market end the year positive. But throughout that year, there may be additional opportunities to perform that conversion at a discount. And once again, allow that conversion, that recovery from that given drawdown to happen inside the Roth IRA rather than happening inside that traditional IRA. Now, every year will represent a different opportunity. The tough part becomes, how do we gauge whether this is a good enough drawdown to perform this given conversion at? We'll talk about that as we move forward. Now, there are a couple ways to think about and utilize a discounted conversion in our situation. I'm first going to talk around a baseline example, assuming no given drawdown. This would assume that we're at the end of the year, we're making our conversion as normal, we're not performing a conversion in a drawdown. And so let's say we were at the top of the 12% bracket and we're deciding to perform a conversion and max out the 22% bracket. So in 2022, there is $94,600 within that 22% bracket for a married filer to be maxing out and converting. Well, if we're paying the taxes out of the conversion, essentially we have a $94,600 conversion. The taxes that we're going to owe, 22%, we're not assuming any state taxes here, it's going to be $20,812. And so what's going to happen after this given conversion, we're going to end up with $73,788 inside of our Roth IRA. So this is the first baseline that we're going to talk through. And so let's first talk through one way you can think about this discounted conversion. And this is basically allowing for a larger conversion based on the equal taxes that we paid. And so let's say that we're at a 20% drawdown example here. And so we're still looking at the exact same overall conversion, but remember, we're converting at a discount. And so we're still performing that $94,600 conversion. We're still paying the $20,812 in taxes. But now after the recovery, we now had that recovery happen inside of our Roth IRA. And so when we look at how much conversion we got out of the taxes that we paid after this given recovery, our Roth IRA, our Roth conversion has grown to $92,235. And so the $20,812 we paid in taxes allowed us to gain a lot more inside of our Roth IRA at the end of this given period here. Another way that you can think about converting at a discount is essentially translating this discount to the marginal tax rate that you're paying. And so within our retirement plan, if we have a forward-looking tax plan that estimates not only the taxes we're paying over the next couple of years, but the taxes that we're paying throughout our retirement based on RMDs and different tax hurdles that we might face, we've arrived at a point where we should be fine paying a given marginal rate. For instance, we might be fine paying a 22% marginal rate to avoid a given rate in the future, but we're not fine paying, let's say, a 24% marginal rate. That gets to be too high. It doesn't make sense in the future anymore. Let's just say that's the hypothetical situation we're facing right now. Well, in a drawdown, we can get a little bit more aggressive with conversions because we can essentially translate that given discount, that given drawdown, to a discounted marginal rate. Now, it's important to understand that if you're converting up into the 24% bracket at a drawdown, you're still paying 24% in taxes. But when you look at the amount that you ended up moving from your traditional IRA into the Roth IRA at the end of this given conversion, at the end of the given recovery, you will notice that you paid a lot less in taxes relative to the amount that you had in that given conversion. And so, again, let's say that we're fine paying a 22% marginal rate based on our forward-looking tax plan, but we're not fine paying more than that. Well, now when we're in a 20% discount, if we translate each of these marginal rates into their given rate that we'd be paying after recovery, we see that we can pay and get a lot more aggressive with conversions. In fact, we can now convert all the way up into the 24% bracket, and after this given recovery, it will be as if we paid 19.2% in tax liabilities here, in percentage of taxes to get that money converted. And so now all of a sudden we can get more aggressive with a given conversion in a given year, because we're paying a lower marginal rate, if that's the way that we want to think about it. Now, it's important to note here that this all depends on us seeing a recovery from this drawdown. We have to expect the market to come back on a reasonable timeline for this to make sense. And so a common question that we receive is, what happens if the market falls further than the point we're thinking about utilizing this discounted conversion strategy? And now, the spring of 2020 during the COVID crash was a perfect example of this. We know now in hindsight that the market fell as deep as around 35%. But let's say we're sitting here in February of 2020, market's down 15%, and we're thinking about a discounted conversion. Well, we know now that converting at down 15% wouldn't have been the most optimal. There were better opportunities for converting. Well, first off, we have to operate with the understanding that we can't predict the market. If we could, this would all get a lot easier and we'd never suffer from that drawdown because we would have traded out of stocks before that given drawdown. But we understand that we can't predict the market. And so how can we move forward with understanding that we might see a deeper discount? And so a conversion rate now might be slightly less optimal. Well, first off, we don't have to be binary. If we're doing a $100,000 conversion for the year, it's not as if we have to do that full $100,000 conversion just because we're at a discount. we can do a portion of that conversion, and then as we see deeper discounts, start adding on additional conversions. And so in a sense, we're dollar cost averaging. We can also simply just be fine taking a step in the right direction, even though we could have theoretically taken a bigger step in the right direction. If we're converted at 15%, we see that there were additional opportunities to convert at 20%, 25%, 30%, 35%. But converting at a 15% discount was still better for our long-term results. And so at some point in retirement, we need to be fine with the understanding that we're not going to be perfect. Now, a very important thing to keep in mind as we're performing a Roth conversion at any point in the year is we can't just wait until tax time the following year in order to make our tax payment on that given conversion. Depending on what quarter we perform that given conversion in, we have an estimated tax deadline where we need to make a tax payment by that given deadline. So let's say that you performed a conversion January 5th. Well, the due date for paying the estimated tax on that conversion is laid out by the IRS. I have a table here on the right-hand side of the screen. It's important to understand that that due date is based off a business day following this given deadline. So depending on any given year, you might see your due date slightly past this given deadline. So for instance, for 2022, the due date for a quarter one conversion for an estimated tax payment is April 18th. If you do wait and forget to make your estimated tax payment for that given conversion, don't be surprised if you have an underpayment penalty or you're forced to pay quarterly estimates going forward in the next year. Again, the IRS generally wants you to pay the tax owed on any given taxable event in a reasonable amount of time. And so they lay out these estimated tax deadlines that you need to stick to. Again, we have a video on our Safeguard Wealth Management channel explaining this a little bit more in depth. I'll link to that in the upper right-hand corner here. But the big message throughout this video is that every market cycle offers an opportunity. During a market downturn, there are tax opportunities that are offered to you, such as performing a Roth conversion, as we discussed in this video, at a discount. Hopefully this video was informational, gave you some food for thought to think about as we start seeing some market volatility moving forward. Always remember that you don't need more money, you need a better plan. If you like this video, please hit the like button down below. It will help other retirees just like yourself find this video and hopefully find some value from this video. Also, hit the subscribe button. We release videos weekly on how you can improve your retirement. Hit the subscribe button. You'll be notified of all of those videos. Thanks for watching. We look forward to seeing you in the next video.